It has been a big week of inflation data. On Wednesday, we got that first report that showed that producer prices were up more than expected last month. And then yesterday, we doubled down on it. We got the latest read on consumer prices, and that index came in hotter than expected, too. Joining us right now to talk about what the data could mean for the Federal Reserve's next interest rate decision is former Dallas Fed President Richard Fisher. He is now a senior advisor to Barclays and a CNBC contributor. Okay, Richard. Hotter than expected inflation numbers, but it's hard to take that in a vacuum. You've got to add on to that the situation in Israel and concerns about what may come next in Ukraine as well. All of this stuff together, what do you think the Fed does next month?
Well, if I were still sitting at the table, I'd say we just stood still. We've had tightening occurring along the yield curve, fiscal policy, massive borrowing, and the planned Treasury auction schedule. Tentative, but for $1.7 trillion new issuance is tightened policy. If some math will show you that if the 10-year goes up 20 basis points, that's the equivalent of a 25 basis point move. So we've seen a lot of movement here. Remember, in July, the 10-year was around 3.6. Now it's at 4.6. The pressure seems to be upward here, Becky. And I think one of the things that led to a reduction in yields earlier, right after the attack of Hamas and the war that's occurred now between Israel and Hamas within the Gaza, is we saw people rush into dollars and we saw yields come down, but now they're coming back up. So I do believe we're seeing a flattening of the yield curve. I'm not sure investors or others are thinking about it that way, are ready for it. But in essence, they're doing the Fed's job. And I don't think there's a real need to move. I wasn't surprised, as you know, that we'd get these surprise on the upside on inflation, both the PPI and the CPI in the core. But still, we're moving in the right direction. So I would sit here, I would watch, I'd let the curve do the tightening for me. And I would also continue to reduce the balance sheet, which is now under $8 trillion as of last Thursday night. So the market's doing the work of the Fed, and therefore they don't have to do a whole lot. I would still have relatively hawkish statement. What you say is as important as what you do, and make it clear you're still going to be on to get that inflation rate down to the 2% target over time.
Richard, let me read you some commentary from Jamie Dimon this morning. You may have seen it already, but in case you haven't, he's a risk manager. He's concerned about issues like this. He seems to think that inflation could run higher, and as a result, rates could run higher, too. He talks about how you've got a really tight labor market. You don't know what's going to happen with Ukraine, what the additional impacts will be between there and Israel, and just points out the largest peacetime fiscal deficits that we've ever seen are increasing the risks, that and government debt levels.
Yep.
Whether or not the Fed acts, you could be looking at much higher rates. Would you worry about that?
I am worried about it. I think we are seeing higher rates. And again, it's creeping out the yield curve. So I rarely disagree with Jamie. He's certainly got a good view here. He is a risk manager. Now, he has said, wasn't too long ago in India, a couple weeks ago, he could see the 10-year at 7%. I am not that bearish, but I could see a 10-year that moves towards the 6% range and maybe pop through it. Again, let's say the Fed decides at some point next year to reduce the Fed funds rate. Again, I could see a flat yield curve or maybe a rising yield curve. I'm not saying it's going to happen, but we're within the realm of possibility here. And all the uncertainty he talks about and all the danger is correct. Uncertainty is the enemy of decision making. It creates volatility. And we're seeing a lot of volatility both on the fixed income side and on the equity side as well. So I don't disagree with him on that.
I don't think a 6% or even a 7% yield on the 10-year is all that frightening of a situation, depending on the timeline. How soon do you see something like that happening?
Well, look at the movement we've seen since the summer and since the spring in the 10-year. And then look further inward on the curve, where the 2-year and the 5-year are. So this is a very attractive, risk-free environment from the standpoint of an investor that's a little worried about all the uncertainty that's out there. It's a place to park your money. Money market funds are yielding 5% plus. And if you want to go out a couple of years, you're still getting over 5%. So it just changes, Becky. I say this every time. It changed the way you have to discount the present value of future cash flows. And now you have a big opportunity cost when you're doing that valuation. When rates were free, we were at the zero bound. You could think forever, go out as far as you want. You can go deeply into venture capital, for example. Well, now that rates have come up and they're getting closer to their historical norm before we at the Fed took rates to zero for decades before, they're sort of right in the middle here, a little bit low relative to history. And I think we're just seeing a normalization. It changes the way investors, people have to value properties, and it's still underway. And if you look at those bank reports, Wells Fargo in particular, but they're talking about commercial real estate, CRE. They're seeing delinquencies. And we're hearing that across the board. It started with the venture world. Now it's moving into the real estate world, particularly commercial office properties. So we're going to have some adjustment here, Becky, and it's not going to be very pretty for those that assumed rates would stay low. They have to readjust to the new world. And I think Jamie Dimon is right.
What do you think the impact of quantitative tightening is, and how long? I mean, is that a given? Is the Fed going to continue with quantitative tightening even if things look a little hairy on other places?
Well, again, they've gotten the balance sheet down under 8, and there was very little change in this last reporting period. We'll see what happens in the next one. But I'm not sure they should defer that mission. And again, the one thing I'm very confident about, having sat at that table for 10 years, knowing Chairman Powell very well, and knowing many members of the committee still, they will not give in to the political pressure that I'm sure will be exerted, and has started to be exerted.
Who's putting political pressure on them?
Well, all you have to do is listen to the senator from Massachusetts. And
Elizabeth
the criticism. Yeah, yes. So, but it's just, I expect them to get a little more. No, it's not new at all. However, they will not succumb to political pressure. It's just not part of the mentality. This is a fiscal issue. The fiscal authorities have to deal with it. They're not. There's total chaos on the fiscal side, massive issuance. The market will determine the price and the yield on that new issuance. And that's the way it should be.